Hello everyone, thanks for checking out my video. The US stock market closed out last week on a winning note as Wall Street interpreted weakening job market and tame inflation as strong signs that the Federal Reserve has to lower interest rates in the week ahead. The Nasdaq Composite notched a perfect week by closing at record highs every single day as tech stocks continued to rise amid renewed AI optimism. The S&P 500, which rose 1.6% last week, saw its best weekly performance since early August and its fifth positive week in 6. With the highly anticipated Federal Reserve decision on interest rates just a few days away, all eyes are now on whether the central bank will deliver a big cut and what that could mean for the stocks in the weeks ahead. Without further ado, let's dive straight into the video as I will share more about what's my take of the Fed's decision. So last week, US stocks pushed to fresh record highs again, even as the latest CPI reading showed that inflation is still proving sticky. But the Wall Street thinks it's likely not strong enough to stop the Federal Reserve from cutting rates in the week ahead. Fueled by Tesla, Oracle, Nvidia and other tech names, the Nasdaq Composite broke through the 22,000 level for the very first time in history and closed at a new record high. Going back to the CPI data, it basically came in slightly hotter than expected. The annual headline inflation ticked up to 2.9% from 2.7% in July, while the month-over-month prices rose 0.4% versus July's 0.2%, which is above the market forecast of a 0.3% gain. But then the market's focus seemed to have shifted. Instead of obsessing over the narrative of a sticky inflation, investors are watching the labor market now. Last week's jump in jobless claims to the highest level since October 2021 has grabbed all the attention. That data, combined with downward revisions to job growth earlier in the week, points to a clear decelerating labor market and reinforces the idea that inflation is well contained. All of this has set the stage for at least a 25 basis point cut from the Fed. And that brings me to the market outlook segment. For the upcoming week, all eyes will be on the FOMC meeting on 16 and 17 September. The rate cut decision and Powell's press conference are scheduled for Wednesday, the second day of the meeting. Prior to the upcoming week, investors have been digesting weeks of economic data for clues on the Fed's next move. As we have seen, the jobs numbers continue to point towards a labor market weakness, which adds pressure on the Fed to cut rates. According to the CME Fed Watch tool, the market has been pricing in a 100% chance of a rate cut in the week ahead. It seems like a cut is without a doubt, but the real question is how big will the cut be? That's what the Wall Street is eager to find out. Beyond the rate cut itself, Powell's tone will be crucial. Could this turn out to be a hawkish cut, which the market might not like it? And let's not forget, the Fed will also release its summary of economic projections, giving investors insights into the central bank's outlook for growth, inflation, and the future path of monetary policy. All in all, this is shaping up to be one of the most information-packed Fed meetings in recent months. From now till Wednesday, there are no major US data releases, so the market is likely to adopt a wait-and-see approach. Last of all, outside of the Fed, investors will also be watching global and corporate events, such as China's economic data on Monday, the Bank of England's interest rate decision on Thursday, and the Bank of Japan's rate decision on Friday. In the middle of the week, for those who are interested, there is the Meta Connect event on 17 and 18 September and FedEx earnings on the 18th September. In short, there are plenty of things to unpack both in the US and globally, and all of it could add more fuel to market volatility. Okay, moving over to the technical analysis segment. Well, there's really not much to analyze at this point as S&P 500 is at all-time high again. I'm just going to be a broken recorder by repeating the same thing, and that is, at all-time highs, it's called uncharted territory. This is where usually sellers dry up while buyers and FOMO investors step in, driving the price higher and higher. I mean, you can see it on the screen. We have been creating higher highs since June this year. That said, this week is unlike any other recent weeks because we have a huge FOMC meeting coming up that could swing the market wildly in either direction. So if the market decides to go higher after Powell's press conference, the sky is really the limit. Without me saying, I think you would also know that SPY will be in the 660s range by then. On the flip side, if the market doesn't like what Powell has to say, I will pay very special attention to the area between 636 and 639. That's where the 50 moving average and the first Fibonacci support level sit. A pullback could bring SPY to this area. The question would then be, will it bounce from here? If it does rebound, it means the bull run is back on and we are ready for a year-end rally. But if it doesn't bounce from this area, then things may get interesting because the short-term trend is potentially turning bearish. Just a quick note, the pullback towards 639, if it's gonna happen, it might not happen within this 1 week. It may take more than 1 week to materialize. But at the end of the day, I think so long as the 50 moving average doesn't get breached, then any form of pullback is nothing concerning at all. Moving over to Apple. Okay, got to be honest on this. I was anticipating Apple to go towards 250s range to basically validate the whole bull flag setup. But it didn't, as investors didn't seem very impressed by their iPhone Air and other product launches. Nevertheless, the share price recovered pretty nicely towards the end of last week. So what's next? Well, the blue line will act as a resistance level again at around 236. If Apple can close above it, especially after the FOMC meeting, I think the probability of it going above the recent height of 241 is pretty high. In terms of the downside, the share price seems to be telling us that the 38.2 Fibonacci level is a nice support. It sits at around 226. And you can see that Apple has bounced off this area on a few occasions. So you might want to use that as a reference point to see if Apple is turning bearish or not. To put it very simply, if this 226 level breaks and Apple starts closing below it, we could be headed towards the 221 level, where the pivotal 50% Fibonacci level, the 50 moving average, as well as the 200 moving average are. And when you add them all up, we can call it a triple support level, which I would say is a strong support. And I think it's quite unlikely for Apple to go below it in the short term. That said, nothing is guaranteed in the stock market, right? Which means if Apple somehow loses this triple support level, it's waterfall time. There will be a lot more downside to go. Let's now move over to Tesla. Wow, that's 2 really huge green candlesticks with 13% gain in 2 days. These 2 candlesticks basically echo or reflect what I mentioned in my previous video. And that is, Tesla is looking bullish after a classic retrace, retest and rebound movement. I also said that we could be back to above 365 easily, but Tesla exceeded my expectations. Anyway, that explains why I had 5 sell puts option on Tesla, which is a bullish move, and they are all sitting on nice paper gains now. Okay, so what's next? Personally, I think Tesla still have a bit of room to go up, but I would be cautious. If anything, my view is that the upside is more limited than the downside, at least for this coming week. So in terms of the upside, there is a decent chance that Tesla might fill that gap between 396 and 401. If we reach this area, watch for the range between 400 and 404. Reason is because 400 is a huge psychological level, 401 is the top end of the gap, and 404 is where the 138.2 Fibonacci extension level is. Let's say if Tesla doesn't get rejected after the gap fill, or better still close above 400 or 404, I think before you knew it, we could be in the 410s range and pushing towards 420. On the other hand, as always, not gonna take up too much of your time. If you appreciate what I am doing, producing free video almost every week, you may consider supporting this channel in the various ways listed on the screen. Feel free to pause the video to go through the details. Alright, back to business. If Tesla gets a retracement, which I won't be surprised, pay attention to the level 367. As you can see, that's the point where it had a breakout. Previously, it also acted as a resistance level, and right now, it is a support level. If Tesla can once again do a retrace, retest and rebound, then wow, more upside to come, man. But if it starts closing below 367, we could be headed towards the purple support line at around 356. From there, if 356 doesn't hold, I think there is a very high probability that Tesla will fill the gap between 338 and 343. But at the end of the day, so long as Tesla stays above the 50 and 200 moving averages, this whole irrational bullish and melt-up movement is still intact. Okay, before I end this Tesla segment, I just wanted to offer some word of caution. When you see this kind of crazy melt-up, 13 to 14% gains in 2 days, all I can say is that it's not sustainable. Don't get me wrong, I'm not saying it cannot go higher. I'm trying to say it needs to take a little break. And that break can be fast and huge. So it's definitely not the time to chase the price. Alright, let's now check out Google. Google is just like SPY, kept creating all-time highs at the so-called uncharted territory. And for this coming week, if whatever Powell said is viewed as favorable by Wall Street and Google wants to go further up, honestly, the sky is the limit. There is almost no need for technical analysis for the upside. We could see 245, 248 or even 250. On the other hand, if the market and Google wants to pull back, just don't be alarmed, we could easily see Google back in the 220s range again. It may take 1 or 2 weeks to pan out though. In the 220s range, watch for 223, where the first Fibonacci level sits. If this level doesn't hold, I am of the view that there is a high probability Google will fill at least half of that huge gap up, which is between 211 and 224. At this area, watch for potential bounce. If Google can bounce off in the middle of the gap or after the gap fill, or bounce off the purple channel line, then things are still looking bullish for Google. However, if Google starts closing back in the purple channel, I do think one has to be a bit more cautious because that would potentially open more downside. Inside the channel, I wouldn't be surprised to see Google back in the low 200s range. But again, this will take some time to pan out if the market makers really want to take profits. Alright, let's now jump over to Meta. Interestingly, without most of us realizing, Meta is forming this nice little downtrend marked by the purple channel. We basically got a series of lower lows and lower highs. For a reversal of this downtrend, it's quite easy to spot. First and foremost, we need the MACD to have a bullish crossover, and then we would want to see Meta closing outside and above this purple downtrend channel. Just to clarify, we need a convincing close above the channel and not a peekaboo kind of movement. So how do we spot a convincing close? Well, I think we can use the gap between 775 and 780 as a gauge. If Meta can fill this gap and not get rejected, then we can say that this short-term downtrend has more or less been reversed. Another potential bullish movement would be Meta breaks out of this channel, retraces back to retest the channel, and then rebound. That will easily bring us back above 780 again. Okay, but on the other hand, if Meta gets rejected by the top end of the channel, then do expect that little gap to be filled, which is between 740 and 743. Coincidentally, this is also where the 50 moving average is. In my personal view, if this moving average breaks, there is a high probability that Meta will fall towards the bottom of the channel, which is around low 700s. That will also mean that the gap between 708 and 721 will be filled. I might consider taking some form of action if the price does reach this gap area. Okay, let's now have a look at Microsoft's chart. Microsoft is still moving sideways and still struggles at the 50 moving average. It has been floating around this moving average since late August and have been creating a series of lower highs. All this add up to a short-term bearish trend. But something positive could potentially happen. Note the word potentially. You will need more signals for confirmation. Okay, first of all, last Friday's little green candle seems to tell us that it wants to break the price action of lower highs. At the same time, it once again is testing the 50 moving average, trying to break above it. One last thing, the MACD seems to be on the verge of having a bullish crossover. So I'm not sure if you get it. For confirmation, all the three things that I have just mentioned need to do what it needs to do, which means break above the recent high of 521 in a convincing manner, close above the 50 moving average with solid candles, and finally have a bullish crossover on the MACD. If all three things happen, I believe we could hit 520 or even go near the 23.6 Fibonacci level at around 523-524 level. On the other hand, if market doesn't like what they get from the FOMC meeting and decides to dump, Microsoft could once again drop towards the 50% Fibonacci level, which sits at around 488. To me, so long as this level holds, we are good. Microsoft is still moving sideways. However, if this 488 level breaks, be mentally prepared that we could see Microsoft hitting 474, where the 61.8 Fibonacci level is. Honestly, I will be very glad if we can see Microsoft back in the 470s range again. Let's now move over to Nvidia. I got to be honest with you, Nvidia rebounded faster than I thought, and it did it in the fashion with that huge gap up and stayed above the 50 moving average for 3 days. That's looking very good. Come this week, watch the MACD closely. If it has a bullish crossover, then we have more upside in the share price. That's when I would expect Nvidia to hit 180s range again and go near the all-time high at 184.47. And if somehow Nvidia can break above the record high, well, you know the drill. At all-time high, it's called uncharted territory, and sellers tend to dry up, which means we will likely see more than one record high. And in this untouched territory, the sky is really the limit, and we can never predict when is the next meaningful pullback. So long story short, if Nvidia closes above 180, I will just not do anything but enjoy the upside. On the other hand, if Nvidia retraces after post-FOMC meeting, watch 174 very closely, because that's where the 23.6 Fibonacci level and the 50 moving average are, thus creating a double support. If Nvidia bounces off here, then it's bullish, but if it doesn't, I'm actually expecting the huge gap up to get filled entirely. This gap is between 170 to 175. Below this gap, we still have a decent support level at 168, where the share price bounced off on a few occasions. I think as long as we don't have too much bearish news in the market, this level should not be broken. But if it does, it's waterfall time. I will cover more of it when it happens. Alright, let's now move over to the options trading section. Just one trade to update this week, and that is this cash secured put on Tesla, which expired last Friday, 12 September. The contract was sold on 8 August with a strike price of $270. Back then, I saw a few bullish signals such as 3 straight green candlesticks with 2 powerful ones. In addition, the share price reclaimed both the 50 and 200 moving averages, and the MACD had a bullish crossover. Just like every single options wheel trade, I shared all my thought process transparently. For this one, it's in the video linked at the top. Feel free to check it out if you haven't. Anyway, since I sold the put option, Tesla has never gone below 300. In fact, it rallied like crazy in the recent 2 weeks. As a result, my contract expired worthless, and the profit for this trade is around $210 US. By the way, just to share, I tried to sell a put option on Tesla last Thursday, 11 September, but the order didn't get filled, and Tesla continued to pop like crazy. And so, like I shared earlier, I decided not to chase it, and I will just let all my existing winners run, while waiting for the next pullback to sell more put options. Alright, here are some of my thoughts. The market continues to be in a melt-up mode, largely driven by a massive AI investment cycle and the prospect of a Fed easing cycle. Although valuations are historically high and uncertainty around tariffs and inflation persists, the "don't fight the Fed" saying appears to dominate investor sentiment for the time being. Add in the technical traders' philosophy of "the trend is your friend," and you can see why the uptrend of the April lows has been so persistent. That said, we are still in September, which historically is the weakest month for stocks. Traders and investors should remain alert for a potential routine pullback at some point. Personally, I think there is a chance for a meaningful pullback in the second half of September, as some investors may wait for the FOMC meeting to find an excuse to take profits, creating a classic sell the news scenario. From a technical perspective, the VIX, which is the Fear and Volatility Index, has been hovering around 15, while the S&P 500 recently hit a new whole number at 6,600. I think there is a chance for a slight spike in VIX later this month, along with some resistance at the 6,600 level, meaning to say a pullback is possible, but a crash seems unlikely. But of course, if the Fed delivers the widely expected rate cut in a dovish and accommodative manner, the pullback might not happen at all. The bulls could continue marching on, and the rally could extend even higher. That's when I would stand corrected. Anyway, here's the thing, don't take my word or any analyst's words as a guarantee. Even seasonal trends like a historically weak September increase the odds of a pullback, but nothing is 100% guaranteed. To me, what's more important is to stay informed about the macro environment and equip yourself with some basic knowledge of the financial market. For example, lower interest rates can generally boost the economy and potentially fuel an already surging stock market. At the same time, be aware that underlying risks remain, especially in the labor market. These concerns are starting to show up elsewhere, like in the bond market or the rise in gold. In addition, inflation could still be a sleeping giant that might get awakened by Trump's tariff plans. Therefore, all in all, I think it's a good idea to start learning these fundamentals, or at least subscribe to my channel for weekly updates if you haven't already. And in the meantime, just enjoy the uptrend. If a pullback does occur, there's an opportunity to pick up shares or sell put options. That's my strategy, at least, not financial advice for you, of course. Overall, I remain optimistic that the AI boom could bring further upside in the final few months of 2025. Alright, that's it for this video. If you appreciate my free content, please drop a comment below and hit the like button. I will see you in the next one. Thank you.